Yeah.
Is it good now?
It's good now.
Yeah, I see it's recording. Okay, great. Okay. All right, this is Javed. Looks like we got a good group now, 14 people. So somebody is, Ahmed, if you could put your mic. Okay, great. Okay, so yeah, you guys can jump in and ask questions anytime to this presentation. Let me take a look if I have any slides. Just give me a second.
Please send your questions. I'll be able to read the questions if you post any in between.
Oh, that'll be good. That'll be good.
I'll be monitoring the questions and you can ask the interrupt Javed in between. That would be great instead of multiple speakers, multiple arms.
Oh yeah, that would be good. That would be good. Yeah, so if you can handle the questions, that would be great.
No.
So I'll start by giving you guys a background of who I am. So I will, and you know it'll be good too. Let me paste my LinkedIn profile. You know what? You have my LinkedIn profile, right, Vijay?
Yes, I have.
Yeah, if you could paste that, that would help people know who I am.
So I'm going to paste it.
Thank you. So I'll give you guys a little background while you take a look at that profile. So I've been on Wall Street for 20 years now, since 98. So actually 22 years, even longer. And I've worked in almost every role you can really think of on Wall Street, in the banks or the brokerages. So I have a good background in finance. I went to school for finance undergrad, and then I graduated from Wharton in 98 and then went into Jeffries and Company, which is an investment bank. And then from there went into equity research. So, you know, the stock analysts that you see on TV, on CNBC and the like, that was me. I did that. And then I worked on the buy side at a hedge fund in 2005 after I went to an MBA at NYU. And then the last 9 years or so, I worked at a Japanese bank as a research person again. Corporate research this time, more in the credit side. So project finance, those big projects that they build in energy, like LNG plants and solar plants. I was the research guy behind that. So I talked to the customers and the clients of the bank about using our bank loans to put money to work in building those projects. So very connected to the markets and capital and finance and figuring out how to make money using the capital markets. In terms of trading itself, I've been trading since I was in college, so around the mid-90s. So you could say around 25 years I've been trading. And it's always a struggle. You're always trying to find a better way to trade, trying to lose less money and make more money. I think in the last couple of years, I got more consistent, stopped making the mistakes I had previously. And that's what I'm here to do, is share with you all how to minimize your mistakes and learn from mine so you don't make them again. Part of that drew me to the covered call trade. That's what I do primarily with most of my capital. So I do covered calls on the ETFs. That's why I like this group, because it's focused on the ETFs. The thing about the ETFs is that I'm not going to use the slides so you can focus on me instead of the slides, but the reason why I like the ETFs and the index in general is because if you learn one thing in finance class, all the professors will tell you that the closest thing to a free lunch is diversification, and the index always diversifies. So when you buy the individual stocks or you do options on the stocks, the companies themselves, then you don't have that diversification. So you have this diversifiable risk that you're taking, and that risk is hard to get compensated for that extra risk. So it's hard to get a reward for the extra risk you're taking. However, when you diversify, at least you don't have the risk of one individual stock. The stocks balance themselves out and they move more harmonically as a whole. So that's why I like doing options on index ETFs. Now, the reason I do the covered call is because it's one of the least risky option trades. It's the equivalent of a cash covered put, so you can do either. They're pretty much the same thing. Cash covered put or a covered call give you about the same premium for the same risk, and they provide you with similar returns. So the covered call trade, let's get into it. Basically what a covered call is you're buying 100 shares of the underlying stock or index ETF, and then you're selling one call contract against that. So does everybody know what a call is, first of all?
Yep.
Okay,
Yeah, almost.
I don't want to confuse anyone. So everybody knows what a call is. So just to review very quickly, a call is you have the right to buy the shares at a fixed price. That fixed price is the strike price of the call contract. You don't have the obligation, you have the right to buy. Now, I am primarily a seller of options. I don't like to buy, and I'll tell you why. When you buy options, you're always running against time. You're always facing the clock. So because every option has an expiration date on it, constantly your option is decaying. That means whatever you paid for it, the option price, also called the option premium, that's decaying constantly. Okay, it's just like milk, or if you buy fruit or vegetables, all of them have an expiration date. After a certain point, they're dead. They're worth nothing. They spoil. Same thing with options. Options also have an expiration date, just like the milk you buy or the cheese you buy, and because of that, it's constantly decaying. Now, when you're a buyer, you're fighting that decay. And no matter what, your option will be worth zero in terms of extrinsic value, time value, by the expiration date. Now, if you're a seller, you have that natural edge. You have that advantage, because when you sell to open an option, as soon as you sell to open it, that option is decaying. So you're collecting that decay, that time value, also known as extrinsic value. And so even if nothing happens, even if the stock doesn't move at all, you get to collect that full time value and keep it for yourself by expiration, because all of that time value goes to zero by expiration. So let me type a couple of things that'll help you understand. So I'll do share screen. Let me open a Word page and I'll type. I think sometimes that helps as opposed to just listening. Here we go. Oh, can you guys see my doc? My Word doc?
Not yet.
Okay, let me try again. Okay, I'm screen sharing. Okay, how about now? Let me write the word test. Can you see that word?
Yeah.
Okay. So an option, you can see it? Okay, so an option price is made of two components. Okay, this is critical to understand why you do covered calls. Okay, so why covered calls and nothing else? Why covered calls? Okay, so option price is made of two components. The two components are intrinsic value and extrinsic value. I can send these notes after I'm done. The intrinsic is the one everybody's familiar with. This is the one that everybody's focused on when you buy the call or the put. The intrinsic value is the stock price minus the strike price, okay? Otherwise known as S minus X, Okay, X is the exercise price or strike price, and S is the stock price. Okay, so that's the intrinsic value. Extrinsic value, or time value, otherwise known as time value, is the remainder. Okay, so it's the option price minus intrinsic value. Okay, this is the part we're focused on with cash covered puts. So this is the part we want with cash covered puts or covered calls. Same thing basically. Okay, and we will get this no matter what. Okay, so we get this extrinsic value if the stock goes up, if it stays flat, or if it even goes down. Because as soon as the extrinsic value is gone, it never comes back. It's gone. By expiration, it's gone. Only the intrinsic is left. That's it. Okay, any questions on that part of it so far? Okay, good. So, go ahead. You want to say something?
Generate income from selling options. I think we are trying to cover that, but before that, I like to ask our audience, how many of you are new to options, where you have no idea what we are discussing here? You can type or chat, or you can tell you can unmute your speaker and then speak.
I am new to options. This is Aditya.
Okay.
Thank you.
So 1, I have 2 in the chat, 2 new, 4, 5, 6. Okay, so we have half of people are new to options.
Okay.
Like,
Okay.
good if you can explain with some from Yahoo Finance or somewhere with example. And I think we have a volunteer who can. Javed Singh, he is ready to offer some example.
Oh yeah, go ahead. Go ahead. Go jump in to offer an example.
Okay, Ravneet, can you explain? You can unmute. Yeah.
He's, I think, posting his examples on the chat.
Wait,
Is I am audible?
Yes, audible, Ravneet. Yeah, go ahead.
Yeah, hi everyone. So, on Thursday, I bought AMD call for 234. Actually, that was my first time I bought any call. Like one of my friend told me, like, let's experience this one. So on that day, it was going up, like it reached to 2.64 or 274, and and after trade, you can say AMD reaches to 79 something. But on the next day, AMD, like after opening, reaches like came back to 77 or something like that, and my call drops to 2.13. So that was my first time. So I think, and I bought it without any prior experience. So can you please elaborate what I made wrong, what I have to analyze pre or post buying?
Yeah, that's a really good question. Okay, good. So AMD, and where was your strike?
$2.34.
That was the price, right? That was the
Yeah.
price.
So for August 7.
Expiration was August 7.
Yeah.
And what was the strike? What was the strike? What was the strike price? Exercise price.
Like on which I have bought.
Yeah.
I bought it at $2.34.
That's the premium price, Ranveer.
That's the
So when you
premium
buy
price.
contract, there would be different price sets. Like it could be like 75, 80, 85, 90, 95, 100. Do you remember what I just said?
At that time, it was 79.
No, the strike is fixed. Strike is a fixed price. So
I think, as I told you, like I bought it because my friend told me to buy.
okay, no problem.
Yeah.
So the key is the strike price. So whenever you are buying a call or selling it, even for that matter, The key is the strike. So the strike, when you're a buyer of the call, is the price at which you can buy the stock. Okay? So if you buy an at-the-money call, at-the-money, ATM, that means the strike is the same as the stock price at that time. Okay? So that means at that point, you can buy the stock at the same price that the stock is trading for. Most people, what they like to do is they don't do at the money, they do out of the money. So that means the strike is greater than the stock price. Okay, the advantage of that is that you are buying the stock for cheaper than if you paid the stock price. Okay, so out of the money, let's say AMD. Where's AMD now? Where is it?
I think it's close to 77 something.
Okay, so let me pull up the stock price. Let me pull up the option prices. Give me a second. I use Thinkorswim. That's what I usually use for my option trading.
So it's 77.43.
77.43 AMD
Yeah.
right now. Okay.
Yeah.
Coming up. See, that one of the easiest ways to look at options is to take a look at the options chain. So you can pull up the options chain anywhere, like Vijay said. You could pull it up on Thinkorswim. You could pull it up on Yahoo Finance. Any broker will have it as well. You can pull it up online. You can pull it up at the CBOE, Chicago Board Options Exchange as well.
Mm-hmm.
Let me change my screen sharing then. Okay, can everybody see my screen? It has a chart on it right now.
Yes.
Okay, good. I'm going to pull up AMD. Okay, then I go to the options chain. This gives me all the calls and puts and all the strikes. So this is the upcoming expiration. I'll do all of them. Okay, so currently AMD 77.43, like you said. On the left side is usually calls, and the right side is puts.
Yep.
It's usually the way you see it.
Mm-hmm.
So let's go at the money. That's where these color changes from black to blue. At the money is 77. Okay, right here are my strikes. See, it says the word strike. That means if I'm a call buyer, I have the right, but not the obligation, to buy the stock at 77 if I buy that call.
Mm-hmm.
If I were going to buy that call, don't look at the last, because not all these trade all day. You have to look at the bid and the ask. The bid and the ask right here. Okay, that's the market. Bid and ask. Bid means the price you buy at. Ask means the price that sellers. So ask is the lowest price that the sellers are willing to take. Bid is the highest price that the buyers are willing to buy it for. Somewhere in between is where the real price is. So the bid ask is 218, 230. Okay, so it should be, in the middle of that is the real price. So the options price would be, what is this, 12 cents? So around 6 cents in. 224 would be the real price. See, the last price was 225, so right around the middle. So 224 is the option price, but the price I was asking you about is about the strike, 77. So here you're paying $2.24 for the right to buy this stock at $77. Okay. Now, what most people do is they want to buy the stock cheaper than the actual price it is, right? So what they'll do is often sometimes they'll buy in the money, sometimes they'll buy out of the money, and sometimes they'll buy at the money, right? But as you see, the option price is much less than the stock price. But you only have a couple of days to exercise this option. If you don't exercise it in those days, then all the at the money options, the options that are 77 and higher, will go to zero. All these go to zero. All of these, 77 and higher. If today was Friday, which is the expiration right here, August 7th, and the price was 77, then all of these would become zero. Okay, that's the problem. So you're paying this option price to buy it cheaper than the actual stock price, but the option doesn't last very long, so the whole option price itself that you paid goes to zero if the stock price is higher than your exercise. Now, if the stock price is actually lower than your exercise, if the exercise price is lower than the stock price, then you have some intrinsic value right there. So let's look at that. So 70s right here is lower than the current 77. So at least this 70 strike option should be worth the 77.43 minus 70, which if you look at the notes I wrote before, intrinsic value. Intrinsic value right here is stock price minus the exercise price. So this should be worth at least $7.43, which is the current stock price, minus the strike price. And as you see, it is $7 and let's say 745 to 770. So somewhere in the 750s to 60s range. So at least it has $7.43 of intrinsic value in it. The reason why is because if you went out in the market and bought the stock, you would pay $77.43. But this option is letting you buy the stock cheaper. It's letting you buy at 70. It's letting you buy at $7.43, less than the market. So the option should at least be worth $7.43 because there's no arbitrage allowed, which means, you know, you buy something and able to sell it immediately for a profit that's really not going to be possible. So the reason why it's not possible, they make the option price worth at least that. Because if you bought at 70 because you exercised the option, you'd immediately be able to sell into the market that same share for $77.43, $7.43 more. So they make the option worth $7.43 in the money options. Okay.
Right.
So the reason why you lose money in buying options, going back to kind of your question, is what happens is people say, okay, I'm going to buy this call option and it's going to go up because the stock's going to go up. And sometimes the stock does go up, but you still lose money in the option. I think somebody's got their microphone on. Okay. So sometimes the stock does go up and you still lose money in the option. The reason why is because this option price is not purely based on the stock price. It also moves because of volatility. Okay, volatility is priced into the option. So volatility on a simple level means the up and down of the market. So if the market is moving up and down a lot, then the volatility is high. That means your options prices will be high. But if volatility goes down very quickly, that means the up and down in the market has calmed down, or there's not as much fear, or people don't want to pay up to protect their stock as much, then the price of the option goes down. So sometimes volatility goes down. Let me write this down here. Volatility goes down. Oh, you guys aren't following my notes anymore, but I'm just going to say it then so I don't leave the screen. Volatility goes down more than the stock price goes up. Okay, that's when you get crushed on your options, even though the stock price went in the right direction. That's why we call this a lotto call. What happens is you're still losing money even though the stock moved in the right direction, because it didn't move far enough, fast enough. And what happened instead is volatility went down far enough, fast enough. So whatever you made because of stock price movement, the option price moved in the other direction faster because volatility just came down too fast. The guys who did make the money, somebody always makes money when you lose money. So the person who did make the money in that situation is the call seller, the one who sold you the call, because they're banking on the fact that volatility will go down and the time value will always go down. It continuously goes down to zero, the extrinsic value. Okay, so that's the part that's left over after the intrinsic value. This is why I like to sell, because even if the stock stayed flat, let's say the stock did stay flat and it's Friday, it's August 7th. Every single one of these strikes, all these options will go to zero. Every single one of these. This value will be completely zero because there's no time value left. So even in a flat market, flat stock market, you're still making money. We've often seen the indices, the index, move flat or stay in a range. Right? I can pull up a chart and let's say the SPY, right? So, and let's look at a chart, longer term chart, like the daily chart. So there's plenty of times when the market, the S&P, like the S&P 500, is very range bound. See, very flat, 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 flat. It's floating up, but for the most part, this is all very flat, right? It's kind of drifting up. And then there are periods before that were even flatter, which are just dead flat. Let me expand my time frame. Okay, right here. Very range-bound market. It goes up, goes down, up, down, but it never really makes any progress. But the people who are selling the calls and the puts are making a ton of money, you know, in this range, even though it's not really making any progress going higher. Okay, because all that time value keeps disappearing from the calls and puts. So one of the typical reasons people like to sell calls or to buy puts is because they want to protect their stocks. So let me go back to the share.
Hey, Javed, I have a question there.
Go ahead, go.
What are the indicators you're using for options? Looks like you have some indicators, right?
So who asked that, VJ?
Yes, Vijay here.
So these indicators, they look pretty cool, huh? This
Screen is not sharing. Could you share the screen again, please?
Oh, you can't see. Oh, did I stop the share? Hold on. Am I like out? Hold on. Here we go. Okay, so if I'm going to really appreciate this. Okay, so SPY is probably the mother of all index ETFs. So what this indicator is, it's not for options really, it's for the index. It's for the underlying index and knowing where the index is going to go. Let me change my expansion settings so you can see it a little clearer. Oh, yeah, it already is. Okay, so I use this indicator to see where the market's going. Basically, what the indicator is built of is my own code that I wrote. Let me take away the volume at the bottom. That usually bothers me. Subgraph. Somebody I think has their mic on again. Okay, so this indicator is ATR bands on basically an exponential moving average, weighted moving average folded into, it's a weighted moving average that's folded into an exponential moving average that's put into the Hull moving average formula. And what that does is it smooths out the lines tremendously. So, you know, you can get into the trend early and stay in the trend. So the signal on this indicator is if the line is pointing down, that means stay short or stay in cash. And then if the line is pointing up, that means stay long or be in position in the market, take exposure. So it's smooth, doing it the way I did, which is a weighted moving average into an exponential into a Hull, keeps it very smooth because the market is not smooth. It's very rough. It's rough, choppy seas. So this makes it look very smooth. This way, when the market is going to go up, I stay in. I get in early near the bottom. I stay in until it changes direction, which is like here. I think on the QQQs, it's even more apparent that it keeps you inside the index ETF. This is the other mother of all index ETFs, the NASDAQ 100, right? The one everybody wants to own. So, you know, it got you out close to the beginning of the pandemic, stayed red. All this is a negative slope. And then when you want to get in, here's maybe 2-3 days in, and you get a positive slope. You know, you would have got in around March 26th. Positive slope, it's all green. Here's a little bit of red. Day of red, maybe a day. Actually, these it was a little red on these bands, but if you see the candles are still green, right? So it keeps you in March 26th, keeps you in, still positive slope. Right here, we got negative slope last week, but it's kind of flat, so it's going to go positive again. So this keeps me in the right direction. So I know where to put my calls and puts too. If I know the market is up, and I know the range. See, notice it shows you the range. That's even more critical for calls and puts. Because with calls and puts, you want to know the range of trade of the stock. If you know the range of trade, you can put your strikes exactly where the candles are going to end, on the high side and the low side. So as you see this top band, if you step back from your screen, and the bottom bands of the candles are very smooth, right? So it's extremely predictive. The width of this range is very constant. So I know the tops and bottoms before they happen. So that's my crystal ball right there. Here's the code.
Hey Javed, this is Karthik here.
Yeah, go ahead.
Yeah, one more question. So when it turns red, right? If it stays flat or if it's gonna go down, like how do you switch? Like if it's gonna turn red, do you lighten up your position or you still hold it? Say 18th of May, right? It's turning slightly red, but yeah, that's a bit of caution. And
yeah, that's a bit of caution. You can lighten your positions. What happened is if you look at, hold on. Let me make it a little cleaner. Just give me a second.
Sure. Yeah, the more of my question would be like, when is it like a heavy warning that you have to get out? Say like 24th of February, right? Like
well,
how do I differentiate?
You won't get it that early. Like you'll get it on the next day. You know, it won't be on this indicator. It won't be the day before. It'll be, let me make this 9 periods. It'll be like the day after. It's pretty responsive. It's pretty early, but it's like the day after. So you're not going to get it here. You're going to get it like the second day right here. So you'll lose all this money here, right? You won't be able to collect right here at the bottom. Here was the bottom. Here was the bottom. You're going to get it like the day after, like day or two after right here, right? On this. Okay, so you're going to lose all this chance of, if you're short, you're going to lose all this money. If you were not long yet, you're going to lose all the chance to make all this money. So I'm not going to get you out on the day of. I'll get you out 2 days after. Right? But
right.
But
sorry, yeah, go ahead.
that being said, this has not changed the slope since March 26th. So this is a lot of money to be made right here.
Got it. All right, cool then. Yeah,
I mean,
say if like, I mean, just probably another question. I mean, I don't want to take much of attention now. I can probably put it in the group later. Now, so even on 24th of February, the market is turning red, and 27th of July also it's red. So how do you differentiate? Whereas 27th of July, I feel like we should lighten up, but 24th of February we should get out. Like, you know,
yeah.
you
Here,
get
like
what
27th, 20. You mean like 20, like March 2nd? You should be lining up on your shorts. After it's down, you should be lining up on your shorts over here. You mean on your short? Or
by
lining up
lightening
on
up
your long over here.
long calls.
Okay,
Yeah.
let me go back there. Let me go back. Go ahead. Tell me. Who is this? Karthik?
Yeah, this is Karthik.
Okay. Karthik, you did direct message me after this call. Okay.
Sure.
But tell me specifically, the 24th here, right? Here.
Right.
Okay, big drop, right?
Yeah.
Okay. So, and then tell me what you were saying about the 24th. Go ahead, tell me.
So, yeah, the question would be like, how do I foresee something that is going to be really bad as, 24th of February to 23rd of March? This is a bad cycle, right? So here I wanted to get out of the market on my long positions. But for example, something like 3rd of February also we see a red, but it's not so much gap down. I'm trying to differentiate between these two. There are some places where we have to lighten up on our long calls, like probably 3rd of Feb or 27th of July. But 24th of February is when we have to really get out, right? Because the market is going to go bad really. But since we have the data, past data, now we can clearly say, okay, you have to get out. But on the day of 23rd or 4th, we'll not know like what's going to come up, right?
Yeah.
How do I decide?
You get it on the day of or the day after, but you won't get it beforehand. Because what'll happen, Karthik, if you're trying to get out here, you're going to get out too many times. You're going to miss these moves, right? If you get out here, you get out here, you get out here, you're going to miss the next couple of candles every time. Because you won't get back in fast enough. You get me?
Yeah.
You have to give up a little to get the rest, right? Okay. You're not going to get this little bit. You're not going to get this little bit. But you will get from here, where the real signal is, on October 8th, all the way to, really, it didn't go down. So here, maybe you'll get it to here, right? But that's what you're trying to get. You're trying to get here to here. You're not going to get all these little bits. If you do, you're going to lose most of your account. Trying to chase these little bits. You get me?
Yeah, got it. Yeah, sure. Thanks.
Javed, there is one more way to track Karthik's question. There is a distribution days count, which we can track on the 500 and QQQs.
Okay, there you go. You got another indicator.
Yeah. So the distribution days count is 5 to 7 in a week of 1 week to 2 weeks period. That's a good indicator where we should get out of the market for the long positions. I hope that answers Karthik's question. That is one way, I know.
Yeah, that helps, Vijay. And also we can use VIX, right? VIX as an indicator, like fear.
Yeah, VIX helps. VIX helps. Here's the other thing you can do. You could do a crossover, right? So the crossover will get you out earlier, right? And it'll get you in earlier too. See, what I did is I moved the period from 9 to 6, right? So the yellow is 6, and the blue is 9. Okay, so the crossover is right here. It gets you out the first day, gets you in the first day, basically, right? But you're going to get a lot of more down moves, right? So you're over trading a lot, right? This will get you out here too, right? Look at the yellow. Right. Gets you out here, gets you out here. Where else? See, actually, it's pretty good. So here a little bit, not really. Maybe one day. Problem with one-day trades is you're out and then you're in the next day, right? You don't want that. Gets you out here, gets you out here, right? So it's very
Right.
responsive. But there's a lot of bullshit going on here, here, here. You didn't need to leave for 3 days or 1 day or 2 days just to be able to catch that one extra day.
Right.
The good thing about calls, if you're doing covered calls, this doesn't matter. Losing this day doesn't matter because you have call premium protecting your position. Okay? That's the key with selling covered calls. It gives you protection. The amount of the protection is the amount of the price of the call. So like AMD. Go back to AMD. AMD was 77.43. So if you sell at the money calls, again, you buy 100 shares of AMD at 77.43. And let's say you sell at the money, 77. Then you have about $2 of protection. Okay, so if AMD went down by $2, you don't lose any money because you collected $2. So that's the advantage of not having to catch the turn on the day of the turn. You can wait and still be okay because you have that protection. That's one of the main reasons people use covered calls is they protect their positions. Now, everybody's going to ask, why aren't you using the right side, puts? Right? Puts are the right, for the put buyer, it's the right to sell the stock at that price. And the reason why people use puts is because it guarantees that they can sell that stock at a price. So, for example, if we bought 77 strike puts and AMD went down to, let's say, 63, we still get to sell our stock at 77. For the right to do that, we're paying $2, around $2, around the same price as the call, a little less, okay, $1.90. So for $1.90, no matter what happens to AMD, even if it goes to zero, we still get to sell our stock at 77. That's insurance. Okay, but the reason I don't recommend buying puts for insurance, because stocks don't go to zero that quickly. Okay, so why are you buying unlimited protection? Instead, if you want $2 of protection, sell the calls, because then you're collecting that premium and you make the money as opposed to losing all that premium. Okay, now if the stock keeps going up, this is not worth anything. It goes to zero. So let's say the stock is at 77 on expiration. All these puts go to zero. So all that protection you bought, that money's in the water. You lose it. It's in the toilet because you didn't need it anymore. The stock went up, so there's no reason to have any protection. So all the protection value goes to zero. So that's the problem with buying insurance. You should be selling insurance against your position. This way you at least make the time value while you get that protection. Now, the problem with selling calls is after the strike price, you lose that upside. So if you sold 77, you collected $2, let's say $2.25. After that $2.25 plus 77, you don't make any upside. So you're basically selling your stock at $79.25. And after that price, even if it goes to 80, 90, 100, you don't get to participate until your calls expire, at which point they'll take your stock at $77 because it's in the money. Then you don't get to make any money past that point anymore. And then you have to take a new position and you'll end up buying the stock higher. So that's one of the reasons people are worried about selling covered calls. However, here's the advantage. You don't care if the stock goes up or not. You're making that $2 regardless. Even if it stays flat, that $2 is fully yours. Even if the stock goes down, you're okay. So what I do is I sell in the money covered calls, deep in the money, like a couple of dollars in the money. Let's say 71. This way I'm getting $6 of protection, so the stock could go down by $6 from 77. Plus, even if the stock went down to 71, I'll still collect the full extrinsic value here, even if the stock went down. So I'm making a profit even if the stock went down to my strike price or higher. So I make profit if the market goes down, I make profit if the market stays flat, or if the market goes up. Now, if it goes below 71, that's when I'm losing money because all the protection value is gone, the $6, and now it's eating into the stock price itself after my protection. So you have to choose your strike prices wisely. That's why I use the chart. The chart lets me know the range of where the stock's supposed to trade for the next couple of days. Using that range, I can pick my strikes appropriately from my covered call or cash covered put. Okay, I think there's probably a lot of questions, so it's a good time to take questions now after giving that brief overview of the basics and then what covered calls and cash covered puts are. Cash covered puts, by the way, are the same thing. You're going to sell the put. You can sell it alone, but you have to have the cash to cover it, or it's a naked put. Just like selling a naked call, it has unlimited risk down to zero price. If you sell a naked put, a call has unlimited risk on the upside. The higher the stock goes, the more you're losing money until expiration. So you don't want to sell naked unless you're very experienced. You want to make sure you're covered. So a call is covered when you sell it by having the stock, because they're just going to take your stock. They don't have to pay any money when they exercise. And a cash covered put is covered by cash. If you have enough cash in the account to buy the stock, when they exercise, then you're covered. You have the money to cover the position on exercise. Exercise means the buyer of the call or put are exercising against you at the exercise price. Call buyers exercise by buying the stock from you. Put buyers exercise by selling the stock to you. And once again, to review, the advantage of the covered call or cash covered put is you're just waiting for time to go by. So the beauty of it, the best analogy, which I failed to use, was you're like a landlord. Landlord collects rent every month. Here, because these options expire every week, you're collecting rent every week. You're just like a landlord, but you didn't have to buy the house. You just bought the stock instead. And the stock is much cheaper than buying a real estate property. 100 shares of AMD are $7,700. And then you're collecting rent here if the stock stays flat or up of $2 at 77 strike. So that's a huge return. $2 divided by 77. To make that money in a week is a lot of money, where you don't care if the stock was flat or up. Either way, you're making money that way. You're collecting your rent check every Friday. Just treating the stock market like a rental property. Okay, go ahead. You guys can ask questions now.
Javed, thanks. That was really good explanation. Would you mind running an example of all the three scenarios? What will happen at the expiration?
Yeah.
And as well as like how is there any risk management involved here? Like if stocks go, say for example, you sold 71 call, right? But if stock goes say 63 or
yes. Who was that? Who asked the question?
Sunil.
Sunil, okay. So Sunil, that's an excellent question. So let's use that example. So let's say you sold 71. So you have, first of all, you have a low battery. Hold on, let me plug in. Sunil, hold that question. Let me step away for 2 minutes, okay? While everybody else thinks of their question. I'm going to answer your question first, but let me just step away for 2 minutes.
Yeah.
All extrinsic. There is no intrinsic. Right. So 71 strike gives you $6. After that, you're losing money down here. Now let's say it stayed flat at 77, okay? And you sold this $6.70. Exactly the extrinsic, and I'll change my columns here so you could see the intrinsic and extrinsic. Okay, now you can see extrinsic and intrinsic right here. Both of them should add up to basically in between the bid ask. Okay, so 71 You see, the extrinsic is very low. It's 25 cents. However, there is extrinsic value there. And most of the value is intrinsic. So you add these two and you get to the middle of this, around that, 770. 670, my bad, 670. Sunil, did you see that? 25 plus 645 equals 670, right?
Yeah.
So when the stock goes to expiration, and let's say it's the same price at expiration, flat, 77.43, then this 25 cents will be zero at that point. But the intrinsic will be the same, 643, okay? Because 71 plus 643 equals 77.43. There's no extrinsic left. So your profit, if the stock stayed flat at 77.43 on August 7th, would be this extrinsic, 25 cents. Not a lot of money. So the trade-off was you got a hell of a lot of protection. You got $6 of protection. That's close to 10% of protection. That's a lot. Most people, though, come in a little bit more. They want to make a little bit more. Here's 70 cents. That's very decent. On a $77 stock, you're making almost 1% in a week, right? So if you made 1% every week, you'd make 50% by the end of the year, right? 50 weeks, let's say. So that's a lot of money to make. You usually don't make that with buy and hold, even on a stock. It's too much risk. Okay, so that's if it stays flat to up, okay? Flat to up, you get that whole thing. Now, let's say it went down to the strike, okay, 74. Even at 74, even if it went down $3, you're going to collect that full extrinsic value of 70 cents. Okay, even a $3 drop, within 5 days, you'll get that. Okay, that's the advantage. So I said flat to up, you always make money, no matter what, right? But if you did in the money, like you did here at 74 or 71, let's say it went down to 71, $6 drop, you'd still make your 25 cents. Underneath that, you start losing money because you gave up all this protection, which went to zero. The call holders lost that $6, and then you start losing money in the stock. Okay, so flat to up, you're making money. Even down, you make money up to your strike if you are in the money, selling in the money. Now, let's say you sold at the money. You're going to collect this $2. Let's say it stayed flat. That $2 is yours, or the 180, which is in extrinsic part, the time value part. All that money is yours. The most money for covered calls or cash covered puts is always at the money, because this is where you get the highest amount of extrinsic. See, the extrinsic goes down as you go more in the money. It also goes down as you go out of the money. The highest is at the money, but you're not getting a lot of protection. AMD could easily go more than $2 down during the week. Then what happened is you collected that 179 because this goes to zero, and then you sell again the next week. The advantage is you at least got that protection, so you lowered your cost basis because of that protection. It might have dropped by 4, but you at least lowered your cost basis by $2 by doing that. Okay, and every time you sell this premium, you keep lowering your cost basis. So if you keep doing this over time, even if the stock stayed flat, you're at a profit. Because let's say you sold this $2 week after week after week. If you sold it for 35 weeks and the stock stayed flat, you made all your 70, let's say 37 weeks or so, then you made all of your money back, even though the stock went nowhere. Now you're starting to see the benefit of selling calls because you're making money and profit even though the stock isn't going anywhere, or if the stock is going very little, or even if the stock drops a little, you're still making profit. You've become almost agnostic to what the market is going to do. You just want to keep selling that premium. So you're continuously collecting rent. It's turning the market into a real estate proposition. Does that answer your question, Sunil?
Yes, super cool. And maybe my blame it on my half knowledge.
Yes.
So do I have to have so when I'm doing this covered call, do I have to have AMD physical stock?
Yeah, that's a very good question. It's a very good question. So yes and no. Okay. So if you want to be covered, first of all, there's different levels of option trading. The first level is covered calls or long calls or long puts. Okay, that's the first level. That's the first level the brokerage will give you if you're inexperienced. Then you get to move to higher levels if you're experienced and if you have a lot of money. You have to have both. Okay, higher levels mean selling spreads. Okay, spread is selling a call or put and then buying another call or put. Okay, so you can sell a 77 and buy a 71. That way you own your max loss is that $6 basically. Mm-hmm. Sorry, if you seller, your max gain will be what you collected here, and your max loss could be the difference between the strikes. Okay, so that's the next highest level. Now the highest level of options is just selling naked, which means you could have just sold this without owning the stock. And you'll collect that premium the same way. But here's the problem. Let's say you sold calls. When you do a covered call, you're covered. So you want the stock to stay flat or up. That's the best scenario. Best scenario is really flat. However, if you are selling naked and the stock goes up, that's a problem for you. You actually want the stock to stay flat or down if you're selling calls naked. The reason is you don't own the stock. So if I sold at 77 strike, naked, no stock ownership, collected my $2, and the stock went up, I'm losing money because in effect you're short. You're naked short at that point. And you have unlimited loss going up. The higher it goes, the more you lose. Okay, so this is why they let very few people do that. And if you don't have the money in the account to cover this loss as it goes up, then they're going to send you a margin call. They're going to call you up and email you and text you and say, put more money in the account. And if you don't put the money in, that becomes an unsecured debt, just like credit card debt. And you'll have to pay that. And they'll hold it against you. And if you don't pay it, it'll affect your credit. And they'll keep sending it to credit agencies or collection agencies until you do pay it. So try not to do things naked unless you have a lot of money to back it up that you can put in quickly. Try to make sure you're covered. If you do this with the covered calls, you'll be covered by owning the stock. If you do a cash covered put on this side and you want to sell these puts instead, make sure you have the cash to buy at the strike price. Make sure that cash is in the account already. So that's cash covered put. They won't issue you a margin call if it goes against you, if it goes down, but they expect you to have the cash in the account at all times to buy at that strike price, that 77 price. Okay, so you don't have to, but it's very dangerous because you have a huge amount of risk of losing money and losing more money than your account has. So that's the most dangerous position. They won't let you have that clearance unless you have experience and you have money and you have income to back it up. That makes sense?
Sounds good. I owe you a coffee.
No problem. No worries. And I know it's a lot to absorb. It's a lot to absorb in a short amount of time. What I recommend is when you're doing these trades, open a separate room that just focuses on these trades, whether it be covered calls and cash covered puts. That should be one room. And then open another room that covers the spreads or the condors. The iron condor is one of the most famous trades that most people love to do when they start an option. And what that means is selling a spread on both sides. So you're selling a call spread and a put spread. And what you're hoping is that the stock stays in the range. So you can sell a call spread, let's say higher, which would be now at 77, right? So you could sell, let's say 82, 87 call spread. So you're hoping it doesn't go over 82. And you could sell below a put spread of 72 to 66, let's say. So you're hoping it doesn't go under 72. So if it stayed within that range, let's say 72 to whatever I said, 82, and it doesn't go past that, then you collect this spread and you collect this spread, both sides, and all that money is yours in the bank. However, it will break one of these sometimes because it goes too far in one direction before expiration. And then you lose money on one side, but you make all the money on the other side. You're hoping that it doesn't break through the whole spread. because then you lose the full amount of money, which is the difference between the strike prices per share times 100. So that's a little more complicated, but that's called a condor, iron condor, or you could do strangles, which is without the spread. You just do the naked strikes on both sides and hope that it doesn't hit, and then you keep collecting that. That's like what market makers like to do on the New York Stock Exchange or the NASDAQ or the American Exchange, Amex. They like to sell those spreads, so they're like creating a market around the stock. So if you're going to do these trades, it's good to focus on one type of options trade and just keep the room focused on that. Then everybody can see what everybody else is trading. You could post your strikes that you're doing every week on the indexes that you're following. And then everybody tries to get better at picking the strikes. Because if you pick the right strike, you're making money every week. You don't have to be at the money. You can be deep in the money and take less profit and be more consistent and then get more aggressive and start getting closer to at the money or out of the money to make more money. Because as you see, the extrinsic value is higher when you're selling at the money or even a little bit out of the money. So the closer you are to at the money, the higher profit you'll get for the week. You know, if you look at things like the triple levered, the at the money is very high. It's like 29, and you're collecting $1.45. That's, you know, tremendous, because 10% is $3. So you're getting 5% in a week. Now triple levereds are very high risk because they move 3 times the index, but you can collect protection to lower the risk. So you can get $2 of protection. You can get $3 of protection and still collect some extrinsic value here just for time going by. That gives you 10% or even higher of protection, and you still get to collect profit even being protected for 10%. The ETFs that most people are familiar with give you less because they're less volatile. So if you look at, go ahead. Somebody said something. So I'm pulling up QQQ, you know, which is everybody's favorite index ETF. This holds all the favorite tech stocks that everybody wants. You're getting around 380 at the money at 265, right? So $2.65 would have been 1%. You're getting a little over 1% here for at the money calls for 1 week. You don't have to sell 1 week. You can always sell 2 weeks. You'll get more money because it's more time. So if you sold 2 weeks ahead, the at the money calls are going for $5. So that's 2%. 2% in 2 weeks is a tremendous amount of money for if the market stays flat to up, you're guaranteed that money. Nobody is getting money at a buy and hold strategy if it stays flat. Let's say it went down by a couple of bucks. You're still collecting money because if as long as it doesn't go below the amount of premium you collected, you get the difference. So if 265, if it went down $2, you collected $5. So you lose 2, but you made 3 profit. Whereas everybody who was a buy and hold straight up just lost $2, but you actually came out ahead. So when you're worried the market is kind of gone up too much and it's going to go sideways or a little bit down, calls are a great way to protect the downside while you can hold the position, or even make some profit while it goes sideways to a little down too on the index ETFs. The reason I love this trade for the index ETFs, because over time, the index ETFs always go up, always, over time. Okay, and we can see that looking back even like 20 years. This is the NASDAQ 100. If you go back, let's say 20 years on this. Okay, look, overall, it's going up. Right, I can scroll back. Okay, even when we had the crash in 2008, 7-8, we made it back to the all-time highs within a year or so after we hit the bottom in March 2009. And then we got back to the all-time highs again, right here in 2010. And go back, if you go back to, let's go back to the 2001 .com crash. Still give it to us. Okay, so we're back here in 2001 crash. SPX, S&P 500. And then as you can see, got all the way down to here, 800. And then the all-time high was around 1510. Then we had the recession. And then sure enough, we got back up there, right? So it always comes back. The reason why it's structural, right? If you think about what the index is made of, the index is only made of winners. I know that sounds a little controversial. The index always drops the losers, right? S&P 500 always drops the winners. That's right, drops the losers. Even better is the NASDAQ 100. NASDAQ 100 algorithmically drops the losers because the NASDAQ 100, by definition, if you go check the website of the NASDAQ 100, it'll tell you that it's only the top 100 market caps of the NASDAQ exchange. So if it's the top 100 market caps, if your company can't be one of the top 100 market caps, you are eliminated from the NASDAQ 100. So by structure and definition, the NASDAQ 100 will only hold winners. That's called survivorship bias. It only holds survivors. All the other companies don't exist anymore in the index. So it, by definition, has to come back to the top all the time. This is why it was smart to open an index ETF group, because the people who own the index or trade around the index are the only ones to really be guaranteed money over time. Because structurally, the index is the market. And since the index only holds winners, the index has to keep going up no matter what. That's something that people don't really understand for a long time. If you think about Buffett and how many stocks he owns, he basically owns the market. He just owned the market for a long time, since the 1950s. So if you compound about 70 years worth of returns, it's not that hard to get to a lot of money. You just keep owning the market. He caught on really early that you own the market and you keep owning the market and you own it for the next 10 years. He ended up owning it for the next 10 times 7, but he still got to the same place. You keep getting back to the all-time highs. And you pile in when the lows come in. Because if you buy the index, there's no problem. If you buy an individual stock when the lows come in, we have plenty of examples of stocks that never make it back and stocks that keep going and they go down to zero. The index never goes down to zero. It's pretty much impossible because it drops all the companies that have the potential to go to zero and it keeps the guys who are going the other direction. What other questions you got? You want to know my trade?
Hey, I have another question, Josh. This is Karthik here.
Yep.
So selling calls, right? Selling calls is mostly like bearish. We're covered calls. I mean, I also have the stock and I'm selling call. That means I'm guessing the stock will go lower, right? I don't want it to go up, like to make more profit.
Let me hold you there. Let me hold you there. Why do you think that? Why do you think that? Let's go back. Why do you think selling calls is bearish? Why would you think that you want the stock to go down?
Okay, I might be a little wrong, or if it even stays flat, selling calls will give me the premium. At least I can collect the premium. But I don't want it to move higher, right? Is that, am I right in my understanding?
No. So you actually make money faster if it goes up because you don't have to wait for expiration. Let me show you. See these calls that are deep in the money? They had much higher extrinsic value before. Much higher because it was lower, right? Stock was lower. So the extrinsic value is closer to at the money. So the 70 had the same extrinsic value as the 77 when the stock was at 70. It had like 179. But now already the extrinsic has gone to almost nothing, right? Ahead of time, even though we're not at expiration. So you actually make your money faster when the stock goes up. Remember, we're focused on the extrinsic value, right? The intrinsic doesn't matter. Even though you're going to buy your calls back at a loss, if you wanted to roll your calls, that's completely negated by the fact that the stock went up by the same amount of money that the calls went up. Because the stock has a delta of 1, and calls always have a delta of less than 1. So whatever the call buyers made, you made more than them because you own the stock. Don't forget, we're not naked sellers of calls. If you are a naked call seller, then you are extremely bearish, like you said. But we're not naked. We participate with the stockholders. We own the stock. Did you get that part?
Okay, yeah, I got it. Yeah, covered calls was like we have to own the stock. Now I get it. So in that case,
you want it to go up because you make your money faster then. You don't have to wait till expiration. If this went from 77, let's say, to 80, 87, this extrinsic would be 0 now or close to 0. But you don't have to wait till Friday to close your position. You can close it early and you made most of your money up front. That's the best scenario for a covered call holder, is when it goes up and it goes up really fast. Because then you don't have to wait for the time decay. That extrinsic value goes down very quickly because the volatility goes down very quickly as the stock goes up. So you can play again multiple times during the week if the stock goes up very quick.
So what is your best suggestion on picking a strike? It's always in the money or at the money?
Okay, so my preference, it depends on what your objectives are, right? So I'm trying to be a landlord here. I'm trying to collect money every single week, regardless of what happens in the market. So my suggestion is you pick the stock price, you pick the strike below which it's not going to go down by Friday. I say do Friday because the fastest decay happens the closer you get to expiration. Okay, I'm going to change my share. Stop share. Let me go out to the internet. Let me show you a graph. Give me a second.
Sure.
Okay, everybody can see my Google now? So
yeah, I can.
Let's say you want time decay versus expiration. Okay, so Investopedia. Okay, so this is time decay, time to expiration on the x-axis, option value on the y-axis. The closer you get to expiration, the faster the time decay kicks in. It's not linear. It's not a straight line, diagonal line. It's exponential. So the further out you are, the flatter the time decay is. But the closer you get to expiration, it's straight up and down. Do you see that, Karthik?
Yeah, I do.
Okay, so the reason why you want to do closest to expiration, meaning, 1 week out, the next Friday, not the Friday after that, is because this is going down very fast in the last week. Okay, so first of all, in expiration, pick the closest if you can, because you're making money the fastest that way, just for time going by. Okay? That's number one. Number two, when you pick the strike, look at the chart, and then find on the chart where the range of trade will be. Okay. There's multiple. You guys all have your favorite indicators. Sure. And I have mine. And I recommend using Thinkorswim because you could write your own indicators. It's all just math, right? Okay, so I try to find...
You cannot see your screen. Yeah, Thinkorswim.
Oh, you can't see my screen. Okay, hold on. My bad.
And actually, I started using Thinkorswim and I find it really good.
Yeah, it's the best. There's nothing that comes close. And if you're going to do index ETFs, what I recommend is use the futures if you can when you pull up your charts, because the futures are the most liquid, right? And that's where all the algo funds, all the volume in the market is built into the futures. That's where most of the volume in the market.
Still, we cannot see you. I don't know if you're sharing.
Oh no, it's me. Hold on.
Oh.
Hold on. New share. Okay. So when I want to look at the S&P 500, I look at the ES. Can you see my chart now?
Yeah, I can.
Yeah. So I look at the ES because that's the S&P 500 E-mini futures. When I want to look at the NASDAQ 100, I look at the NQ. Okay, so that gives you more liquidity to look at. It's cleaner chart. So what you want to find is the range of trade. Okay, so look for the next 5 days and what the range would look like. So as you see, these lines here, they give me what the tops and bottoms of the candles should be in the future, basically. Because look, notice the line here and the line here, it's pretty much the same width. It's a little squiggly, but for the most part, the width is the same, if you notice, right? And it's very consistent through the entire pandemic recovery. This width has not changed very much, which means mathematically speaking, you can pretty much tell the next 5 days where the range of trade is going to be. 1, 2, 3, 4, 5, bottom band. 1, 2, 3, 4, 5, back to the top band. 1, 2, 3, 4, 5, bottom band. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Bottom band, top band, right? So if you know the top and bottom, you know where to sell your strikes, because you want to pick the strike that is underneath where the lowest candle will be in the future. Because if you pick the strike right there, then you make all of the extrinsic value for that week. And you don't lose any money in your account. At that point, you're truly a landlord, because you pick the strike above which the market is going to stay. Now that's just math, okay? You have to draw your lines here that basically encompass the range of trade and project those lines out to the future, okay? This is a daily chart. You don't need much more than a daily. You don't have to go crazy and do a 4-hourly, hourly, 5-minute chart, 15-minute chart. You know, as a covered call or cash covered put seller, you're not scalping, you're not swing trading. You're basically just collecting rent. So try to figure out the range of trade for the next week. If that's too short, then go 2 weeks. It's still pretty exponential decay. Still very fast for the last 2 weeks. Then you give yourself a little more time to move for the stock to stay in the range that you need it to be. And that's how you could do it by delta too. So you can choose a certain delta. I'll tell you where I am on my trade. I do triple levered NASDAQ 100, TQQQ. And my strike, right now the NASDAQ, the TQQ is at 119 on Friday. My strikes for the next couple of weeks, and I did 4 weeks out, and I have a reason for that. I usually do 1 week. My strike is around 103 and 105. Now, if you look at the chart, conveniently, that seems to be the bottom of the trade, all the way going back to around here, July 6th, for like a month now. That has been the bottom. So no coincidence there, right? So anything above my strikes of 103 to 105, I will make the full extrinsic value of what I sold. And I won't lose a single penny in my position, so I will have collected rent for a month right there. That make sense?
Yeah, it did. So just a follow-up question. So why not get into this trade 2 days before expiry, right? Like,
okay, very good question, actually. Very good. Now the questions are getting very specific. That's an awesome question. Why not do it on expiration day, right? Because that'll be it's decaying every second, right? Decaying every minute. There's no free lunch in the market, as my professor always tells me, right? There is no free lunch. So you tell me what the problem is of doing it so close.
Right, probably the theta decay would come in, and what else? Like, I think the
Extrinsic value is already 0.
Yeah,
zero.
thank you very much. That's it. Who said that? Who said that?
Sunil.
Sunil, you're dead right. So let's go and look at the chain. So on the SPYs, let's say the S&P 500, and let's go to, here it's hard unless we do on demand. Let's do on demand then. So on demand lets you look back in time. So it's just like Sunil said, if we put SPY in for, and I'm warning you guys, if you don't have a good computer, it's going to kill your computer. It's I don't know why, but it's very heavy in terms of resource use. Let's go to last week on Thursday, July 30th. Two days before. Okay, it's already killing me here. But trust Sunil, it would be extrinsic value of almost 0 because there's very little time value left. So even though you're going to lose it very quickly, you don't have a lot to make at that point. Here we go. Now it's coming up. Critical low memory. Trying to kill my machine. You know, try to get like 16 gigs of RAM when you do this on demand. It's pretty useful. It's just slows everything down. Okay, so 321, let's say at the money. And keep an eye on the extrinsic column. You got 2 days left here because it's July 30th and it's expiring July 31st. We're opening at the market. 320, got to keep scrolling down a little bit more. And at the money should have the most extrinsic. Here we go. Extrinsic. Intrinsic. SPY. Sometimes this thing's a little quirky. What am I doing wrong here? $181.
Does the platform maintain the history of the prices for the?
Yeah, it does. It does maintain the history of the prices.
Okay, because we are trying to look at history. That's why.
Yeah, we're trying to look at history. I don't know. The prices seem a little off. It should be close to 0, probably because my memory is not that great. Here, let me go back here. But it should be what Sunil said. It should be very close to 0 when it's the same day or day before. There's not much left. So you're going to capture it pretty quickly. There's just not a lot left at that point. That's all. That's all. So if you do a week in advance, 2 weeks, you got a little more meat on the bone. When you're doing a day or two before, you're much better chance of it going to 0, the extrinsic, but there's not a lot left. So, you know, there isn't a lot left because most of the theta decay already happened at that point. But there is some. So I have a friend who does this every 3 days a week because on the SPY or the ES futures expire 3 days a week, 24, 27, 29. Okay, Monday, Wednesday, Friday, they expire. So he does it the day before or the day of. He's even done it in the afternoon of expiration on the SPX futures. There is some juice. It's just very little. But, you know, what people do, since it's very little, they do it with a lot of money. We're talking like over $100,000, tens of thousands of dollars, squeezing out the pennies, as they say, picking up the pennies in front of the steamroller. So it's very high probability of getting that money because you only have a little time left. And if that time the stock doesn't go above the strike, then all that money is yours. But if there's a big swing in that afternoon or the day before, then you get hit. So I like the trade. It's just not a lot, so you end up putting a lot more into the trade to make the money, and then you're risking a lot more. That's the only the problem. You have a lot more capital at risk with a high probability of winning. But there's plenty of people who do that trade. They just do it day of or day before. On SPY, you could do it 3 days a week if you want, and it'll expire. You could do it the day of and do it in the afternoon where there's only 3-4 hours left. That's totally fine. I have a buddy who does that 3 days a week religiously. It's doable. You're just not going to collect not too much. So he does it with a lot of contracts.
Awesome. Yeah, I mean, thanks. That was
great trade.
really awesome.
It's a great trade. You're collecting rent 3 days a week. Where can you do that outside the options market, right? You're literally collecting rent 3 days a week. It's a phenomenal trade. There are people who can live off that money, just collecting that expiration money.
Sure, yeah. That's a great idea, yeah.
Yeah. So what I do is I target around 1% a week on the TQQQ. So I'm selling enough premium to give me 1% return for the week. So TQQ is around $120. So I target around, $15 in the money. That way, if the TQQ goes down by $15, I still collect my 1% a week. When you do that with a couple of $100,000, I do it with around $700,000 in the TQQ. So I make around $7,000 to $10,000 a week, and that's a good portion of my supplemental income. Or now that I'm out of work since January, that is my income, but it's better income than I made in my salary. So I'm happy with it.
That's fantastic figure, Javed.
Yeah.
So next time, when you buy those ETF, would it be possible for you to share that at what price you buy, so that we can also take a cue and maybe we start investing or replicating your investment ideas?
Yeah, that's fine. I mean, what I'll recommend, I'll give it, no problem. What I would recommend is running a list of people. So I'll put it in, and then hopefully everybody will follow. You don't have to put the number of contracts. You don't even have to have a real trade. Even if you're paper trading, that's fine, because paper trading, you're still following it. You're engaged in the trade. But what I would recommend is everybody put their stock and their strike and expiration on a list in WhatsApp. And, we follow that, because when you see more people are doing it, it encourages people to keep doing it and keep getting engaged. They don't think it's just talk or theory. So I'm happy to share mine. But what I would recommend is keep the list running every week to see what everybody else is doing too. So I would put TQQQ, I would put August 7th, and then I will put 103. That's my strike. Or I'll put all my strikes, 103, 103.5, and 105. And I would say that everybody put their name down and put their ticker and their strikes and expiration. Don't worry about the number of contracts. It doesn't really matter to us. But at least if everybody can see what the strikes are, then we're almost like crowdsourcing what the actual market believes the market is going to do. And if you have enough people doing that, you have a much higher probability of winning, because you have more eyes and more ideas in the market helping you decide what the right strike is. And then ideally, you'll be making regular income. So I've been in other trading rooms where there's 20 people that put their strikes down. They were all mainly triple levered ETFs like TNA and TQQQ. And everybody made money last week. Like, everybody's strikes were below the stock price by Friday. So every single one of those people who posted their trades, those 20 people, they all made money. And we all knew they made money because the stock price ended higher than their strike. So now maybe 20 more people will come in next week and follow them, so that we're all making money together. And that's the key. Once you create a supplemental source of income, like a landlord, then your whole life changes, because if you make more money outside of work, then you make more money in work. That's what most people don't realize, is the way to make more money at work is to make money outside of work. Not to leave your work, but to actually get promoted at work, because you'll challenge the ideas more. You'll ask for more resources. you'll ask for promotions more aggressively, and you'll get more responsibility and get bigger teams. So you'll get credit for the wider amount of resources that you command. And that's how, you get promoted at work, get to the senior levels. And then it's a virtuous cycle because you're making more income at work, you're putting more income into your outside investments, and then you're making more money in your outside investments with lower risk. That's the key I didn't mention. The reason I have 700,000 is because I only need to target 1% and still make 10,000 a week. If I only had 70,000, I would be taking much more risk to make a decent income. Because when you have more money in the market, you take less risk because you're still making a decent amount of absolute dollars. And then that outside income grows as I put more money into it from my inside work income. And it's a virtuous cycle. It keeps feeding on itself. You make more money outside, which pushes you to make more money inside work, and it just feeds on itself.
So, it's Lalit here. I think you made a very good suggestion by actually doing those posts. There's a lot of theory. Obviously, I've been at this for a little while, so there's quite a bit of theory, and we execute quite differently. We have different strategies. But once we start actually watching these posts and following the posts, as you suggested, it'll build that level of confidence and it'll give you some idea of where to concentrate. So today I've heard a bunch of questions were very interesting and really got to the crux of the matter, I think. So I think that idea of putting those posts with the price and the strikes would really, really help, I think, in terms of expediting the learning process.
Yeah, I agree. See, there's too much to learn out there. You could spend a couple of lifetimes and you won't learn it all. But at the end of the day, what makes you consistent money at a low risk is key. Because when you take low risk, you're consistently making money in the market. You're not treating the market as a gamble. You're not treating it as a buy and pray. I call buy and hold, buy and pray. There's nothing wrong with buy and hold. You should always have a portion of your portfolio, just naked index ETF, and hold it. You'll make very good money. The other part that you want to be more consistent, that you might want to live off of and pay your bills with, use calls and puts to make that more consistent like a landlord. And then lotto calls, that's fine. If you want to do, buy a call, buy a naked put, and bet that the market's going to move in a certain amount of time, that's fine. Just don't make it a huge part of your portfolio. If you want to do individual stocks, that's fine too. Just make it a small part of your portfolio. If you make the largest part of your portfolio the index itself, then over time you're only owning winners. And that creates generational wealth over time. You should have enough that you could live off of it before the regular retirement age if you do it consistently and stay engaged in the market. The beauty of this trade is it's like 10 minutes a week, maybe 5. And that's it. You're not doing anything else. You just leave it, wait for expiration, collect your rent, do it the next week. If you do 2 weeks out, then you're spending 10 minutes every 2 weeks. If you do 1 month, like I've been doing, then you just spend 10 minutes for 1 month. And then at the end of the month, like a true landlord, you do the next month again. You want to minimize your engagement in the market. Don't buy, sell, buy, sell, buy, sell. Just make one trade every week, collect your money from the market, and then move to the next week, and compound your returns. And if you could do this in a tax-free account, I know it's different laws in Canada, but I'm in New Jersey. I do most of my trading in my rollover IRAs. So this is money that I rolled over from previous jobs. I won't pay a single penny of tax on it the whole time it grows, even for years and decades. I only pay tax at my current income tax rate when I finally pull it out. And what I'll do is I'll roll it to a Roth. I'll pay tax once on a year where I didn't make a lot of income. And then I'll never pay tax on it again because that money grows tax-free and comes out tax-free once you pay tax on it once. So all that compounding will generate tax-free distributions for the rest of my life after I roll it over into a Roth IRA. The Roth IRA is totally legal no matter how much income you make if you roll it over into a Roth. That's a backdoor way to get into a Roth. You cannot do it just from your salary contributions if you're over a certain income level, but you can do it if you backdoor if you roll over a regular IRA into a Roth IRA. So then you don't have to pay tax. But even all these gains are tax-free gains, at least until I pull it out. So I recommend trying to do it as tax efficiently as possible.
Thank you so much, Javed. I think this is one of the best discussions I have participated in a long time. And I know this is something, this could change the course of the game
Yeah.
in due course. I'm so excited. I'm actually looking forward to your messages, your buy
No
and
worries, no worries. Once you treat the market as another salary in your house, then your entire life will change. I guarantee you that. It changes everything.
Yeah, and I think it's Lalit again. I think as Sunil just mentioned, this is probably one of the better sessions I've ever attended. I've attended quite a few of them, paid ones too. And I think what I get from you is this willingness and this openness to share. So any questions that have been asked so far, I didn't feel a sense of holding anything back from you. So I think that's greatly appreciated that you're willing to share your knowledge and plus all the experiences you've had without holding anything back. So I think that's going to go a long way, at least for myself, and I think for most of the folks that are quite interested in moving this way.
Yeah, totally. See, the reason, one of my biggest motivations for doing it is because I learned from all of you. It's too much to look at, in the market, and it's too hard for one person to make all the mistakes that need to be made. So when we're all looking at the market, we all have different perspectives, we have different views, we have different creative ideas of looking at the market in a way that others won't. The reason my indicator is so consistent here is because I built this, using what different friends thought about the market and different ways of measuring the market and putting math towards it. So the combination of all the ideas helped build better indicators. It's the same thing with the strikes. If you all think about the market in different ways, you'll come at the strikes better than if you're working on it individually. I always learn when I do one of these sessions because somebody always brings up something that I didn't necessarily think about. Or when we all put our strikes up and we have calls, what I would encourage you to do is after you put your strikes up, after 4 o'clock or 5 o'clock when everybody's off of work, to go discuss how was their experience during that week or during the day or the last couple of days. What did we have trouble with? What have we improved upon? What are our learnings? Because then we all learn faster. You're compressing the time of learning. And when we learn from each other, we'll get farther ahead quicker than trying to learn alone. There's no reason to go about this alone. It's too hard to do it alone. I've been in rooms where we learn together, and you see people who didn't know what a call or put was, and within a month, they're regularly making income because they learned from their friends, and their friends were more than happy to teach each other. This room on WhatsApp has a great vibe where other people are giving each other advice, and I think if we continue to lift each other up that way, then we'll all learn a lot more quickly together, and we'll get more confidence too and get more consistent. That's the key. Okay, I think that's a good place to end then. Feel free to schedule these again, get other speakers. What I would recommend is there's a lot that was lost in this discussion for anybody who's a beginner. So it's very important to teach, the basics of calls, basics of puts, what a call is, what a put is, different examples. I flew through it quickly to get to the heart of the matter, which was covered calls and cash covered puts and how that becomes a landlord strategy. They call it a share lord strategy. You could look it up online, share lord. But I just glossed upon the basics, the intricacies of call, put, stock price, strike price, expiration, theta, delta, probability of getting hit, all these things I didn't cover. So if other people could do those basics on different sessions, it'll help everybody get to the same plane of learning. So nobody's like confused and they give up early and it's just glossed over and they're like, this is too hard for me. Because it's not complicated. It's just a lot of material, but it's just practice, just like playing a sport or playing an instrument. You got to learn the basic building blocks like Lego and know them inside out. Know what a call and put is inside out and what drives the price inside out. Then you practice, just like playing a sport, but know the basics of the sport first. So if other people could volunteer, even, put up a document that has great links, I can share some videos from YouTube that are great for the basics of calls and puts, some other resources like Options Industry Council, that have free webinars of teaching and before the pandemic, they did it in person. And then some YouTube videos and any other resources. I'm sure you guys could find better resources than the ones I come up with. And then have the guys who know a little bit more teach what these basics are and record it so that you can play those back and people can look at those references to come up with more specific questions on their trades. And so they know what's going on a lot faster. Okay, I'll let you go on that note. Enjoy the rest of your weekend, everyone. And feel free to direct message me. You guys all know my name in the group. So if you have any direct questions, ask me anytime.
Sounds good.
Thanks a
Thanks
lot.
again for all your efforts.
No problem. Thanks, Vijay, for arranging the call, and Sunil.
Hey,
Thanks.
thanks. I have one.
Yes.
Awesome, and thanks, Javed and rest of the group.
No
Yeah, I
worries.
think we should catch up like maybe once in a month. Let's plan to catch up once in a month and see how we are.
Absolutely, yeah.
Yeah, definitely. Anytime.
Yeah. So Javed, please keep posting your messages in WhatsApp. I'll copy paste you, and that's how I actually started learning. Like some of my friends who are a part of this group, Vijay and Karthik, they started with options trading. I didn't know the ABCs of options trading, but now I'm frequently into options trading. At least for the last 1 week, I have been. But before that, I was like very frequently into options trading. So as they say, associations make a lot of impact on us. I'm so happy to be associated with this group and looking forward to learn and, as you said, like make an income by being a share lord.
Yeah. Perfect. I love it. I love it.
And thanks, Javed, and belated Eid Mubarak to you and others.
Thank you. I appreciate it. I appreciate it very much. Thank you. I wish you all a very good weekend, and thanks for the holiday wishes. Appreciate it. You guys have a good weekend. We'll talk soon.
Take care.
Thank you, everyone.
Thank you, guys.
Thank you, everyone, for your time joining. And thank you, Javed.
Thank you.
Bye.
Bye-bye.